Hello and welcome to Worldview. And my guest on the show today is someone who has several introductions. Rockstar economist, the man who was able to predict the imbalance ahead of GFC crisis, former RBI governor. But I would like to introduce Raghuram Rajan as someone who has this ability to perhaps make the complex world look very simple. His ability to really predict, explain, and then really decipher economic trends is quite extraordinary. He's also someone who has dedicated his last few years in teaching and sharing his thoughts to the young generation. And he's promised me that today he is ready with all our difficult and even easy questions. Dr. Rajan, it's an honor and it's a pleasure to have you on ET Now. Let me also extend season's greetings on behalf of Team ET Now and our viewers before I start the interview.
Thank you. And I wish I was as prescient and knowledgeable as you make me out to be. We'll see.
Dr. Rajan, I'll start with a simple question. What is your view of the world? 2024 was all about news and views. What do you think will influence the script of 2025? Because we are staring at a world right now where there are a lot of imbalances and there is a lot of concern which is centered around what lies ahead.
Yeah, I think that it is uneven and it's also greatly uncertain going forward. Uneven because we have, for example, the US tearing along, uh, growing way above what people thought was its potential. Potential growth in the US is about 2. It's growing at 3. And that's been persistent for some time, despite the best efforts of the Federal Reserve to slow it down. It's uneven within country. In the U.S., for example, the lower middle class is hurting from the inflation. Some of that was seen in the election results. You're seeing men, feel a little worse about the economy than women. But also, it is uneven because between countries, you have a lot of difference. Europe, for example, is flirting with recession, especially the country at the center of Europe, which is Germany. France has high levels of debt, has a fiscal deficit, which is going to be hard to cure given the political situation. And you have a lot of developing countries which are highly indebted in sub-Saharan Africa, for example, and which are looking for debt relief. They've borrowed a lot, both from the Chinese as well as the multilateral institutions. And finally, you have India, which is chugging along at around 6%, give or take, the variation across quarters. But even in India, the question is 6% enough for our long-term ambition? And is it reaching all segments of society? It seems to be, at this point, quite beneficial to be in the upper middle class in India, while the lower middle class again is worried about the future and what it holds for it.
So before I get into specifics of India, Dr. Rajan, the biggest talking point for everyone is that how will the world change after the change of administration in United States? There is fear, there is anxiety, there is a lot of debate, and there is a lot of deliberation. Is the world prepared for Donald Trump?
No, absolutely. And this is the uncertainty portion that I was talking about. If things went along as they are, then you would expect that the usual prognosis, at some point, the Federal Reserve will have put enough weight behind its monetary policy regime so that the economy slows. This is what people have been saying since the perhaps the beginning of 2023. And you would see it in the numbers, and we would have, with high probability, a soft landing in the US. And where the US goes, certainly it helps carry some of the global economy with it. The big uncertainty, of course, is President Trump. His economics are not the old economics of the United States. It's more America first. And America first means every country that runs a fiscal surplus, a current account surplus with the United States, is deemed a kind of somebody who's taking advantage of the United States, and therefore it is appropriate for the United States to try and bring down that current account deficit, not so much by containing its own spending, which is what economists would say is the first line of attack, but by elevating tariffs, etc. At the same time, he's also coming into an economy, into a world where there are big geopolitical tensions building up, certainly with China, and also potentially with the axis, Iran, China, Russia. And so there is a sense that his unpredictability may help. It may sort of result in certain in certain kinds of bargaining which reduce this kind of geopolitical risk, but it may also go the other way, that it may aggravate the kinds of tensions there are. For example, he has repeatedly said he's going to levy 60% tariffs on China. And it seems that those tariffs are likely because it does three things. One, ideologically, he believes that the current account deficit that the U.S. runs with the trade deficit that U.S. runs with China is something that can be brought down to through tariffs and will create U.S. jobs, both of which are questionable propositions. But he firmly believes that. Second, there are a lot of China hawks on his cabinet, and they believe this is a way of keeping China down. And third, he also sees tariffs as a way of raising money to fund the kinds of tax cuts that he has in mind. So, for all these reasons, it is quite possible that China bears the brunt of the tariff attack. And what China does is completely, at this point, also an unknown how it retaliates. Does it sort of meekly accept, or does it levy retaliatory tariffs? And it's already said that it might do that. And then we have a disruption in global supply chains. We also have a lot of Chinese goods looking for a home elsewhere. And that's also going to be problematic. So disruption is a possibility as we go forward. And that's something that has a great number of people worried at this point.
Dr. Rajan, in 2016, when Donald Trump came to power for the first time, the markets were nervous. Wall Street came down. The bond markets were a bit shaky. But the reaction this time is very different. While in general, you've expressed that the world is prepared for Donald Trump, but do you think Trump 2.0 could be strikingly different from Trump 1.0?
Potentially, but it could go either way, right? Again, this is the big uncertainty because a lot revolves around the personality and ideas and decisions of someone who is fairly unpredictable. Um, on one hand, it may be that he has learned from his past experience and therefore knows what could work, what may not work. On the other hand, it may be also that he's learned how to deal with some of the ways his past decisions were sort of offset, both by people within his administration, but people outside also. And he may know how to sort of shut that opposition down and carry through his decisions. A couple of areas, immigration. Last time on his actions against immigration, including building the wall, there's a huge amount of opposition. The courts were activated, and the net effect was they didn't go as far as they wanted to. This time, they're far more prepared. Stephen Miller, his prime anti-immigration architect, is a deputy chief of staff in the White House, and they know how to combat the lawyers, etc. So it could be the actions against immigration are larger and more abrupt, and you could see significant increases in deportations. But of course, that is enormously disruptive to the US labor market, which is already quite tight. So areas like construction, areas like restaurants, dining, those could get impacted. And the spillover effects to confidence, to immigrants even help hold up consumption because they're relatively poor and spend a bigger fraction of their income. So all this could be quite disruptive to the economy in the short run if it's carried out. So which Trump will we see? The person who's older and wiser about these effects, or the person who's more determined to carry them through? And of course, he has a big mandate from the electorate. What is surprising is that people sort of want him to do their favorite thing, but they don't think he will do other stuff. So the business people all think that, oh, he's going to deregulate, but don't think that he will elevate tariffs to disrupt their global supply chains. You talk to business people and they say, we have no idea what he's going to do, but we hope he does the right thing.
Dr. Rajan, in the past, you've maintained that you cannot ignore US debt for long, and the world so far has ignored it. There is a new word which everybody seems to be using on Wall Street, which is bond market vigilantes. So, at what point in time do you think the high debt of the US government could really start bothering A, financial markets, B, global growth?
Well, I think the truth is nobody knows. What the US is going for it is the TINA factor. There is no alternative. Where would you put your money in today if you're a big player? Europe is fractured, and Europe has some countries like Italy and France which have high debt levels. Italy has a lower fiscal deficit, but France has, political difficulties in narrowing its deficit. So when you put your money in Europe, you're sort of betting on the collective alliance sort of staying together and supporting the weaker countries. That becomes a bigger question mark, especially as Germany goes into an election. UK, we already had the Liz Truss moment, and it's not clear it's that strong an economy. Uh, uh, that's a worry. Japan has much higher levels of debt than the US and is also an aging economy. So you worry about putting your money there. And of course, China is relatively closed. So what that leaves, and China is not doing well, of course, that leaves a lot of smaller countries which are healthier, the Scandinavian economies, Switzerland, Singapore, but you can't put a whole lot of money there. So what the US is going for it is it's one of the few safe assets that people can still invest in and feel comfortable that their money is relatively safe. What could tip it over? I mean, this doesn't mean that risk premium cannot go up on U.S. debt. In fact, they probably will, especially if the kind of deficit expansion plans that the incoming administration has are put into play. Extension of the Trump tax cuts, a reduction in corporate income taxes, etc., and some of the more extreme election promises, for example, no tax on tips and so on. I don't think all of them will be carried out, but they will tend to add to the deficit. And the deficit is already big, 6.5% in normal times when the economy is chugging along at 3. Imagine what would happen if there's a slowdown and the deficit expands because of the natural expansion of fiscal deficits and slowdowns because you've got to spend more as a government, unemployment insurance, etc. So the worry is that at that point, the combination of politics and bad economics can, in fact, create more worries about the debt. I don't think there's any chance in the near future that the US will have difficulty financing, but the price at which it finances may go up. And that's the big worry that in a fiscal situation where you have close to 100% of debt, net debt to GDP outstanding, with interest rates going up, it becomes a vicious circle. And there will be a lot of pressure on the US to bring its deficit down, which may not be a bad thing. The bond vigilantes were talked about a lot in the 1990s, and given where the debt is, they're being talked about again, which is reasonable.
Dr. Rajan, before I turn the page on India, what is your view in general on what central bankers are likely to do? Because central bankers now are really following the independent policy, which is that China has been decreasing rates, Fed has moved and has paused, India has not moved, and Japan seems to be following a different trajectory. Do you think in 2025 central bank action could be very differentiated, or it will continue to remain joined at the hip?
Well, I think it depends on the degree of credibility and the depth of markets in their country as well as their economic situation. I think it becomes harder, no matter what central bank you are, to cut significantly, keeping in mind that the Fed is maintaining interest rates and may even have to go the other way if some of the actions of the Trump administration turn out to be inflationary, such as prolonged increases in tariffs or a action against the labor markets through, for example, immigration reform. So if the Fed stays higher for longer, I think the effect cascades to other countries. Europe, for example, finds it harder to cut interest rates despite the weak economy because the euro starts, depreciating relative to the dollar, causing some imported inflation. I think in Europe, they will be less worried about this because the sort of sensitivity of the euro US interest rates is sort of more moderate than, for example, a country like Brazil, where there is a real worry that both in terms of domestic politics, which is causing a higher fiscal deficit, but also the exchange rate vis-a-vis the US, which is more volatile with both domestic policies as well as US financial conditions, that that Brazil will see a much greater depreciation in the currency, and therefore will have to take more action. In fact, they have been taking more action because of that recently. As far as India goes, I mean, on the one hand, we have plentiful reserves. But on the other hand, the question is, what is the value of the rupee that we will be comfortable with? The problem for India, to some extent, is the enormous sort of importance of the dollar rupee exchange rate. We don't look at the exchange rate vis-a-vis everything else, but everybody knows the dollar rupee exchange rate, and that becomes a signal for confidence in the economy, etc. I think we will have to be a little more relaxed about the value of the rupee when everybody else is depreciating against the dollar. We don't want to stand out and hold rupee values where they are and thereby lose some competitive advantage relative to other countries. At the same time, it's critical that it be seen as necessary depreciation rather than depreciation driven by a lack of confidence in the Indian economy.
So, Dr. Rajan, I won't use the word RBI and draw you to political, hot waters. But as an independent observer, India is growing at 6%, which is in and around its mean growth. So, for a country like India, where growth is 6%, fiscal deficit is coming under control, economy seems to be chugging along rather smartly. what to your mind really should be the ideal forex reserve? I'm asking you this question because that in a sense is crucial on the way how currency could move and what kind of inflation rate dynamics we could have.
I think, unfortunately, with the world as it is, there's never a comfortable level where you can say, we're pretty much a fortress balance sheet. But I think, current levels are quite reasonable. They're approximately 17-18% of GDP. That's quite reasonable. There Another way of measuring it is in relation to imports. How many months of imports? There we're okay. I think the we do have to pay some attention to our trade deficit, which is a little larger on the good side than we would feel comfortable with. In the last month, we saw a big expansion in gold imports, for example. Is that a trend or is it a blip? That's something to worry about, because sometimes our upper middle class sees gold, as well as I guess across the economy, sees gold as a safe investment. And as they worry about the economy, they start moving into that. So those are things to be alert about. Um, I would also not take our debt as something to feel comfortable about. When the nominal growth rate in GDP was really high relative to uh, um, our interest rate, I think you feel more confident, because as GDP grows, it brings down the debt to GDP. With nominal growth rates in GDP now coming to 8-9%, and the interest rates on the debt being more like 6-7%, there's not that much headroom for us in terms brought to us by growth. And large fiscal deficits can turn into an expansion in debt, which always is a warning sign for markets. So we have to be careful about not being overly, we need to be careful about the quality of spending. We can't sort of spend as if there's no constraint. And I think both on the central government side as well as on the state side, that kind of improvement in expenditure, accompanied by fiscal restraint, is warranted.
So, Dr. Rajan, I'd like to draw your attention to something which you referred to, which is that the Indian economy is not moving in a very linear manner. It is more like a K shape. Now, what does this K shape or post-COVID recovery mean for India's long-term trend line of 6%?
Well, I think the K-shaped recovery was clearer earlier, and now it's not clear what the shape is, which I'll come to in a second. Um, uh, the K-shape was, in a sense, the fact that the upper middle class was recovering quite strongly from the pandemic, while the lower middle class seemed to be hurting. And you can see it most clearly in the consumption numbers. For example, for passenger cars, you saw the sales of passenger cars sort of shoot up and exceed the pre-pandemic numbers. But you didn't see that happening with two-wheelers. In fact, only now do we see two-wheelers, which are bought by the middle class and lower middle class, come back to their pre-pandemic levels, right? So this was the K-shaped recovery, that somehow the middle class was not feeling confident and didn't have the consumption power. And if they had the consumption power, some of it was supported by increasing levels of debt. Um, what you're seeing now is perhaps the upper middle class also seems to have exhausted some of the pandemic savings, and seems to be a little more cautious about their spending. We're seeing passenger cars showing some signs of resistance, while two-wheelers, perhaps supported by a sort of stronger prospect of harvest and so on, are picking up once again. Again, just about flirting with their pre-pandemic levels. But the inequality in consumption spending should worry us, because longer term we need to have a strong domestic market if we are to offset some of the uncertainties coming from the global market. Our goods exports, as we saw last month, are seeing some resistance. They're not growing at the pace they were growing. Of course, our service exports are doing really well, and that's something we could talk more about. But given that, I think we need a strong domestic market. I think some of this has to do with the future. How does our low middle class see the job situation? Many of them, especially kids who have been educated, are looking for decent jobs, and they're not finding it that easy, which suggests, youth unemployment is really high, and they're finding that they're all trying for the same thing, which is government jobs. And so you see these enormous numbers of applications for government jobs. For them, the government view that we have 3% unemployment is not very, satisfactory, because they're saying, I don't see 3%. I see so many people around me unemployed. So this is actually a really important concern for the government, for opposition parties, for state governments. How do we ensure that our youth, our population dividend, so to speak, is actually realized, as opposed to wasted away because we can't find jobs for them?
So, Dr. Rajan, now that you've made a case for India's GDP growth, which is the 6% trendline growth, and barring that pandemic year, can I say that the next coming 5 years will not be strikingly different from the last 5 years? Because if India has to grow at 6%, well, that is our current rate, which means that we should not expect anything bumper from the economy.
No, look, we are still below the trend line if you draw, assuming there was no pandemic, right? We're about 1 year behind in terms of growth. That, of course, has effects on our youth. Our population doesn't wait because there's a pandemic. It was moderately affected by the tragic deaths in the pandemic, but very, very small relative to the overall growth of the economy. So there are lots of youth who are looking for those jobs, right? And the really important concern is, yes, at 6%. In a few years, we will overtake Japan, maybe within a year or two, depending on the exchange rate. We'll overtake Germany, both of which are stagnant. But after becoming the third largest economy in the world, we still have the question: how do we get rich before we get old? And India will start getting old faster than other countries because it has very little immigration into it. And you can see that in the South and the West, as the fertility rate falls with wealth, women don't have to want to have so many children. And a number of southern states are already saying we must up the population growth rate because we are shrinking, or likely to shrink, even while the North and the East continue growing. So you already see within country tensions sort of start picking up as a result. The delimitation issue is looming in front of us when seats have to be readjusted to population. So the real question for us is there enough growth to paper over these differences? And almost surely there isn't, because the right comparison is not with other rich countries that are basically stagnant. It's with China that at our stage of per capita GDP. And as many Chinese economists love to point out when they're trying to show how China was doing better, China was growing at double-digit rates in 2004-5 when they were at our per capita level of GDP. And, we need that kind of growth to be able to sort of grow somewhere near middle income by the time our population dividend gives out. Put another way, we were growing at 6% for a long time. but this is the time we are getting the population dividend. Our growth rate should be up just from that by another 1, 2, 3%. So we are underperforming. I think that's absolutely clear relative to other countries that are successful at our per capita level of GDP. So that it's a qualified answer. 6% is wonderful comparing to other big countries today, but it's underperforming relative to other countries at our level. So that should be a wake up call for every government official that we need to do far more to up the rate of growth.
My last but one question, Dr. Rajan, which is what is your understanding of the banking sector? Because in 2016, when you took charge at the RBI, there was a different challenge and it was a different battle. You had to clean up the NPA mess. Now things are looking up. PSU banks, they had to be capitalized by the government, or I would say they had to be rescued by government. Now they are all reporting profit and giving dividends. What is your understanding of the Indian banking system? Is it robust, or it's a matter of time NPAs will strike us, because banks ultimately are a cyclical business?
Yeah. So let me start by clarifying some misunderstandings from what I've said in the recent past, which seems to be a game of Chinese whispers. Look, the wrong thing to think about the banking sector is it's driven by corruption. It was not corruption which created the. It was not primarily corruption which created the bad loans in the system the last time around. It was a slowing of the economy after the global financial crisis, and it was the fact that policy slowed down. So many of the infrastructure investments that had been made were delayed. And you remember the coal blocks, for example, were withdrawn, and so it actually made it very difficult to start up. And as a result, many of these projects lost money. So it was, in many ways, the bigger factor was the euphoria in both borrowing and lending pre-global financial crisis, after we had grown very strongly, and there was a sense that everything that was invested in would come out right, and it turned out that wasn't true. So the NPAs built up. Yes, there was some corruption. There always is some corruption, but that wasn't the primary factor. I think the what one has to be careful about is that banks are central to all the risk taking in the Indian economy. We sort of think, oh, we've told the banks not to lend here or not to lend there, and they're safe. But NBFCs borrow from the banks, microfinance institutions borrow from the banks. So banks are involved in many ways, not just from their direct lending, but their lending through intermediaries, the investment in intermediaries. And so we can never be confident that there is no risk building up. So, for example, recently we've seen the RBI and SEBI express concerns about retail loans funding, for example, stock market speculation. That is a worry, because the bad loans come back to haunt bank balance sheets. Banks have been on a retail lending spree, thinking that it's safer than the kinds of large investment projects that they used to invest in. But of course, they need not be, especially if they're unsecured and people lose their jobs. A downturn could bring a lot of defaults in that sector. Similarly, we've had a whole lot of mudra loans, where the kind of default rates that sometimes you see, as opposed to the official numbers, are quite alarming. So they've, by some counts, they've come down a little, but it is something that we have to be vigilant about, because those loans went up significantly over the last few years. So, put differently, I think the last thing a supervisor or regulator wants is complacency. You want to constantly be vigilant for new sources of trouble, and typically, it's not the old sources of trouble which give you concern, but new ways of getting into trouble that banks find. And I welcome the fact that banks have low NPAs, that they are profitable, returning dividends for all the capital that was invested in them by the government. But this is no reason at this point for the regulators to stay pat, and I don't think they are. I think they are trying to be vigilant.
Dr. Rajan, since you alluded to the word stock market, let me take the liberty of extending that further. Now, we've seen two parallel trends in Indian stock market. One side is the SIP culture, which is genuinely built on long-term investing, and second is this entire big, massive rise in F&O activity, which some would say is speculative. What is your view on how the stock markets have evolved? Is it in line with the real economy? And do you fear that this mammoth loss which has come in the F&O market that could haunt us going forward?
Well, I never know and don't ever have a official view on the level of the stock market. What I will say is it's a healthy phenomenon that the more participation is taking place in the stock market. For a long time, I thought it was a problem in India that some of our best stocks were held largely by foreign investors. Our own domestic investors were not benefiting from the rise in the valuations and so on, but also our own industry was not benefiting from the risk-taking abilities of our people. Risk capital was deficient in India, and much of it was provided by foreign investors. So I think by and large, it's a good development that more of our investors are coming from inside, and they are benefiting both from the rise, but also willing to take more risk. That said, you always have to be careful that they are not investing in stocks beyond their means. The fear of missing out sometimes causes a lot of inflow into the stock market, which then comes to a sad end when the stock market declines for whatever reason, sometimes even for external reasons to India. So it has to be that people are not stretching in investing in the stock market. It's a small part of their portfolio. It's not dominating their portfolios, especially as they're older, because that is the source of a lot of grief. There are also some places where I simply don't understand what is going on. Single day options. I don't see why there should be so much interest other than from a gambling perspective. And risk taking is not the same as gambling. I certainly would worry a little if I saw a lot of young people borrowing to invest in single day options. That seems to me a recipe for longer term problems, especially when we hear that hedge funds are making a ton of money off them. That would suggest that somebody is losing a lot of money, and I would worry about their situation. So, by all means, I think it is a reasonable development that so many are now, have a stock market account. The success of some of these online brokerages is very heartening. On the other hand, I would also be vigilant that they don't, get overly exposed, especially through borrowing, because that could create both problems for the stock market, but more or as important, distress amongst individuals, which we should be very wary of.
And finally, Dr. Rajan, if I may ask you a personal question, what is that one thing you miss about RBI?
Well, the RBI is a unique institution in India. It is seen as a institution which has great integrity, but also often because of its capacity, is called upon to help in different ways. For example, help the government assess its debt profile and so on. I met with a couple of RBI junior officers just 3 or 4 days ago, and they were so eager, so interested in doing something good. Some of them taking advantage of some of the scholarships that the RBI has to study further and bring some of those capabilities back to the country. So it's a unique institution. I think it serves the country well. For my part, what I miss most is, as you leave office at the end of the day, you always felt that there's some possibility you moved the needle, that you actually helped, improve the economy. Remember, we were dealing with difficult times at that point, trying to build up the reserves again, trying to deal with the NPA problem that had built up, but also, trying to at the same time do longer-term reforms which would stand the country well, such as inflation targeting. So it was a extraordinarily sort of fulfilling time. And that's when you realize that being in such a position is a privilege. And it's very important to sort of give back as much as you can when you're there.
Dr. Rajan, an absolute honor and a pleasure, sir, to have you on ET Now. Best wishes once again for a great year ahead.
Well, Happy New Year to you and to all your listeners, and happy holiday season. Thank you very much, and good luck.